Everybody, welcome to Money in a Hot Minute, where I answer your money questions quickly. Today's question comes from Mopolo, and they asked, what I don't get about ETFs is how safe they seem to be. They have a net positive return over the last decades. I would like to know what needs to happen so that ETFs would be net negative, inflation aside. Would we need a decade of stagflation or a decade of a recession for ETFs to go negative, basically, is what this person's asking. So to start answering this question, we want to break down what an ETF actually is. It's an exchange-traded fund. Imagine a basket, okay? And imagine a bunch of stocks in that basket. Well, you're buying that basket full of stocks. You're just buying that one basket instead of buying all those individual stocks. So you own that one basket, which means that you also own whatever's in that basket, which is all those stocks. So you're a shareholder of all of those individual companies that are in that ETF, right? So an ETF is kind of like a shortcut for getting invested. It's really easy and accessible, it's cheap, and it's a way for you to just have to own one thing, and by owning that one thing, you own a bunch of companies. So what would have to happen to cause ETFs to be negative? Now look, historically, yes, if you look at certain ETFs, they've appreciated in value over time. Not all ETFs, it totally depends on what the underlying investments of that ETF are, right? If you look at an ETF that tracks, say, the S&P 500 companies, then, over time, yes, that has continued to track higher. Right now, we're seeing the market sell off, but that happens. The market goes up, the market sells off, the market goes up, the market sells off. It's called the business cycle. We have periods where the consumer is very healthy, the consumer is spending, and then we have periods where that is not happening, and we go into a recession and growth slows, goes negative, interest rates, maybe have to come back down to try to spur economic activity again. That causes stocks to contract when we go into a recession because of many reasons. One is going to be if the consumer doesn't have the money to spend, they're not spending it on these companies' goods and services. Therefore, these companies' goods and services are starting to decline. Therefore, their stock prices decline. So a recession, will cause an ETF to decline. And remember, the ETF is really just representing all of those companies. So I want you to make sure that you compartmentalize that, and that when we're saying what's going to cause an ETF to decline, well, if those underlying companies that it's invested in decline, then the ETF is going to decline because the price of the ETF is essentially an average of the prices of those companies that it's invested in. So that's kind of the simplest way to think about it, right? So if we do go into a recession, that will cause stocks to decline. It's happened historically over and over and over again. And then stagflation, which is what we're actually looking at right now. We're looking at potential stagflation as growth slows or goes negative and inflation is high at the same time. That is not good because that's kind of the situation we're in right now, actually. We're seeing inflation spike. We are seeing the highest inflation we've seen in multiple decades, I think over 40 years. And that is a problem because we're also seeing our economy slow down and we're seeing growth kind of normalize again. And we're seeing issues because of war overseas. And just generally, the consumer is kind of recalibrating after all the stimulus money that the consumer got in 2020 and 2021. So that's what's going to, yes, cause an ETF to decline, but it's not a reason to panic. We've seen this happen over and over. We've seen so many different events cause the stock market to sell off. So if you're invested in an ETF that's invested in stocks, then that ETF will sell off too. But over the long haul, like I said, it's a business cycle, and this is going to happen. We're going to have points of strength in our economy, and we're going to have points of weakness in our economy. points of high employment, points of low employment, points where the consumer has a lot of extra cash to spend on goods and services, and times when they don't because maybe inflation is eating into their disposable income, like we're seeing right now. And we're seeing that risk of stagflation and a recession because of those things, because of inflation eating into consumers' discretionary income. But on the flip side, I did a video kind of going over a lot of this stuff in more detail. You can check it out here. And just know that this is not out of the ordinary to see stocks sell off. Typically, long-term investors reap the benefits over the long run and generate returns over the long run. An ETF, it's just a more convenient way to get invested. It's a less volatile way because if you own one stock or just a couple of stocks, you're not as diversified. If you own an ETF, you own a lot of different companies that ETF invests in. So your portfolio is more diversified. Therefore, it helps with volatility the more diversified you are versus just owning a few direct names and seeing really big drawdowns. That would be a much different scenario. So that's why the term safe, I think that's what you mean when you're using it. I wouldn't necessarily see it as that. I would just see it as less volatile and more diversified, which makes the risk lower, but you're still getting exposure to the downside in the individual companies, if that makes sense. So kind of a long-winded answer there, but hopefully that helped. If you have a question that you want answered, make sure you put it in the comments below and like this video if you learned something. Subscribe to my channel if you're not, because I put out all kinds of different content around finance, money, investing, and I'll see you in the next video.